Welcome to this lecture on financial management, where we'll explore the critical distinctions between investing, trading, speculating, hedging, and gambling. Understanding these differences is essential for students of finance, as these terms are often used interchangeably in casual conversation, but have distinct characteristics, time horizons, and goals. First, let's define investing. It's about allocating capital with the expectation of generating returns over time, primarily based on fundamentals and long-term growth. Long-term investing typically spans years or even decades, such as buying shares of Apple to benefit from its sustained growth in earnings and dividends. Short-term investing, on the other hand, has a horizon of months or quarters, like buying bonds with a one-year maturity to earn interest income. Next, we have trading, which involves the frequent buying and selling of assets to profit from short-term price fluctuations. Day trading is a prime example, where positions are opened and closed within the same day, such as buying Tesla shares at market open and selling them before close. Speculative trading involves taking positions in volatile assets with higher risk for potentially high returns, like trading options on meme stocks such as GameStop during 2021. Beyond capital appreciation, some strategies focus on generating steady cash flows. Examples include writing covered call options to collect premiums or buying dividend-paying stocks like Coca-Cola. Investing in real estate investment trusts for rental income distributions is another way to create steady income. Now, let's delve into speculating, which means taking on higher risk positions, often with leverage, to profit from expected price movements. A classic example is buying crude oil futures, expecting supply disruptions to significantly raise prices. Unlike investing, speculating places less focus on fundamentals and more on anticipating price movements and precise timing. Hedging is a strategy that uses derivatives or other instruments to reduce risk exposure from existing positions. For instance, an airline might hedge its fuel costs by purchasing jet fuel futures to lock in a price. Similarly, an investor holding international stocks might hedge currency risk using currency forward contracts. Finally, we have gambling, defined as wagering money on an uncertain outcome where the expected returns are often negative due to odds or the house edge. A clear example is playing roulette in a casino where the outcome is purely based on chance. Gambling typically lacks an underlying asset or fundamental value, distinguishing it sharply from investing and trading. To summarize, investing focuses on long-term wealth building, grounded in fundamentals. Trading aims for short-term profit seeking from price movements. Income strategies are designed to generate steady cash flows. Speculating involves high-risk, high-reward bets on market movements. Hedging protects against losses in existing positions. And gambling is pure chance, typically resulting in negative expected returns. This comprehensive table provides a clear overview of each concept, highlighting their distinct characteristics. By understanding these fundamental differences, you can make more informed financial decisions and develop effective strategies tailored to your goals and risk tolerance. Thank you for watching our lecture on financial management, focusing on the distinctions between investing, trading, speculating, hedging, and gambling. Point. See you at the next lecture.